Welcome to More Than Money with your host, Ross Murray. This episode of More Than Money is brought to you by More Time Financial, a financial planning company who are on a mission to help young Australians make smarter decisions with money by providing real-life financial advice, coaching, and financial education.
Hey, what's up? It's Ross Murray. Welcome back to another episode of More Than Money. On this podcast, I have real conversations about lifestyle, money, and business. Sometimes I share interviews with business owners about starting their own business and their journey. Other times I do financial education and informational episodes to help you make smarter decisions with money, just like this one. So if you're new here, consider subscribing. Now, before we get started on today's episode, there's just a friendly reminder in order to keep our lawyers happy that in preparing this podcast, myself or any contributors have not taken into account any particular person's objectives, financial situation, or needs. So before acting on any of this information, you should consider its relevance to your personal circumstances and, if required, seek the assistance of a licensed professional. So following on from last week's episode where we covered the basics of investing for beginners, we had a number of questions from you, the listeners, about investing. So in this episode, we're going to try and answer some of those questions for you. As I mentioned last week, whether we're just starting out or you're just starting to save and start looking at investing, it's important that you just build your own knowledge. So hopefully by going through some of these questions with you today, it's going to help you get some additional information so you can make smarter decisions about what you should do when it comes to investing. And as always, if you would like a question answered on the show, be sure to follow the links in the description below and we'll do our best to answer your questions on a future episode. So let's get into the first question. All right, so John asked, I'm new to investing, where do I start? So John, the thing I'd be thinking about, as I mentioned last week, is being super clear before you start investing of what are your investment goals, what are your timeframes, and what is your risk tolerance. So if we understand those three things, then making the decision of where should we start investing becomes a little bit easier. It can still be a little bit daunting to make your first investment, but it's important just to understand those couple of things. Then once we know that, it's just about educating yourself. So understanding what different investments you have, whether you're talking about investing $2,000 or you're investing $200,000, that's going to obviously make a big difference about what your investment options are and what are the risks and how's it going to affect or how's it going to get you closer to those goals that you have. Now, I would suggest you do as much research as possible. So YouTube's great, obviously podcasts like this, and a number of different free resources out there. And then if you do need additional assistance, you can reach out to a financial advisor or someone like myself to obviously assist with that if it's needed. But I would suggest you do your own homework first before reaching out to a professional. And if you're nervous about investing for the first time, you can always invest a small amount to begin with and gradually increase it up. So let's say you had $50,000 sitting there and you want to make an investment. It's quite daunting to think about investing that whole $50,000 in one go. So what you can potentially do, and it's what we do with our clients, is what's called dollar cost average, or we invest in regular amounts over a period of time. So it's not putting it all in at once. And then obviously there's a little bit of shock factor that comes with, I had $50,000 in my bank account and now I've put the full $50,000 into the share market or into a property or something like that. So I would look at potentially doing something like that, where it's just you look at doing small investments and that can kind of get you started. The other thing I'd think about is, assuming you have been working for a period of time, you would have superannuation, in some amount of superannuation. So whether you know it or not, you are currently invested. So I always find it's a really good thing to do is look at your superannuation and find out where it's invested, how much you have invested, how it's been performing, because that's your money. You are, in fact, already have an investment account. It's just called your superannuation account. So by doing that, it starts to open your eyes up to see, okay, well, maybe you've got $50,000, $100,000 or $200,000 sitting in your superannuation account. You can start to see how investments work by looking at what your superannuation has done. So I always find that's a really good way to kind of get your foot in the door in terms of understanding a little bit more about investments. So that would be my suggestions. Hopefully that helps, John. So the next question came in from Mary, and Mary asks, I'm not sure if I have enough money to start investing. What should I do? So Mary, my suggestion to you would be that it's never too early to start investing, even if you only have a small amount to start with. And what you can do, much like answer to the previous question, is you can start with a small amount and make regular contributions over time. So there are a number of micro investment platforms out there that let you start investing with, I'm pretty sure, as little as $100. So you can start off doing $100, whether that's weekly, monthly, fortnightly, whatever time frame you want to do, until you start to get comfortable and obviously start building up more and more money to start investing. So it's always a really good way to start, where you do a little amount as depending on what you have, and depending on how much you have will allow you to invest in different platforms. So as I mentioned, the micro investment platforms be a really small minimum investment or initial investment, And then if you started to look at investing in other companies or other platforms, then they have certain minimums. That might be $1,000 or $2,000. So what we find with some of our clients is that if we're starting off to begin with, they might already have an investment account set up with like a micro investment platform, and they can start putting small amounts in. And then once we start building up more and more savings, we can then look at different platforms and things where we can start putting in larger amounts. And as I mentioned earlier, you can start off with $100 a month, and then you can increase that to $200, $500, $1,000 a month as you get more comfortable and as obviously your savings builds up as well. But again, it's just important to understand what are those goals, prioritize savings, build up your savings, and start investing as much as you can to get you to close to that goal. I would also suggest if you just do a quick Google for a compound interest calculator, you can see the benefits of investing even a small amount over a long period of time. So $100 a month over a 10, 20, 30 year period, it's crazy to see how much that can grow to over a period of time. So that would be my thinking there. Thanks for the question, Mary. All right, question number 3 comes in from Tom. Tom asked, what are some good investments for beginners? So there's no one investment for everyone. So it's hard to say this is the best investment if you're a beginner. It, again, comes down to what are those goals, what are the timeframes, what is your risk tolerance. However, there are a number of investments out there that are what's called diversified investments. So it's not one investment that you're invested in. So you choose an investment. They're called index funds or managed funds, or exchange traded funds is probably the most common one at the moment, where you're invested into one product, I guess, but it's invested in a number of different companies underneath there. And what helps is you're not choosing or you're not relying on one investment. You're not saying I'm picking this one fund and I'm going to invest my money into there. You're investing and then you're diversifying across a number of different asset classes, sectors. So you're kind of spreading your risk and diversifying your money across a number of investments. And that's a really good way to kind of start to see how different investments work. So if you only choose one investment, you just choose one company and you invest it in there, you're just going to be looking at the performance of that one investment, and it's going to go obviously going to up and down, hopefully up more than it goes down, but you're not really going to get a sense of how other investments work. So how does a share work versus how does a property fund work? And it's really good to kind of see it across a different spectrum when you're beginning, because it lets you know, okay, well, that was interesting that over the last 3 months or 6 months, my share portfolio that was in Australian companies did X, Y, Z. My international shares did something different, and then my property funds or related investments did something else. So it's kind of a good way to see how different investments perform in different environments, even if you're only starting with a small amount. So that would be my suggestion. And again, similar to how much you put in, the complexity of your investments can increase over time as well. So you might choose something like a low-cost index fund to begin with, and that might be super simple, super boring, but over time, as your investments grow, as your confidence grows, as your education grows around investments, you might start looking at making more complicated investments and multiple investments if you needed to, or you could stick with like a simple, boring approach as well. So the opportunities are endless. But again, just do your own research, find out as much information as you can, and then from there. Thanks for the question, Tom. All right, the next question came in from Sam. Sam said, I'm worried about taking too much risk. How can I minimize risk with my investments? So this is quite a common question and completely understandable, because investments can be scary. If you look at the news kind of on a weekly basis or a daily basis, you'll see the share market went up, share market went down, like people lost their money or people made money. Like it can be a little bit scary. So completely understand. Simplest and easiest way to reduce your risk while still investing in something appropriate for you is diversification. That is one of the easiest ways to minimize the risk. And so diversification is investing in multiple assets. So rather than picking one, as mentioned earlier, picking one fund, one Australian company, single share, and investing in there, you're solely reliant on what's happening with that one company. Whereas diversification means you have some money in Australian shares, some money in international shares, some money in Australian property, international property, maybe emerging markets. I'm not throwing around a few different terms here, but if you do a quick Google search of like, what are the top Australian shares? What are the top international shares? What are Australian property funds? What are international property funds? What are emerging market investments? So you start to spread your risk over different assets and different investments. So if the Australian share market goes really well, but the international share market goes down, you're what's called hedging your bets between the two. If the property funds go up, but the Australian share market drops, it kind of balances out that risk a little bit. So that's one option. The other one is to spread your risk over having some money in cash, so having that money in savings. So always making sure that we have that emergency fund, of course, before we start investing, but having that money, some money sitting in cash, maybe some money in a term deposit, some money in shares, potentially some money in property, if that's possible, some money in bonds. So you're spreading your risks across different asset classes, and you're also diversifying as well. So this reduces the risk down. So similar to what we spoke about in the previous episode, where we have defensive assets and we have growth assets, we can balance your risk across the two, so to help reduce that risk, but still making investments. So rather than just leaving all of your money sitting in a savings account that's not really going to go very far, you're still taking investments, but you're reducing that risk. As we've said all along, it's having those goals, understand what those goals are, and then how much risk do you need to take is one question, and how much risk are you willing to take? So how much risk you need to take, you never want to take more risk than you need to. So if you've got a super simple goal or a super simple investment strategy that you only need to do this amount of investments over an X amount of period of time, if we don't need to take much risk, then there's no need to take that risk. So we want to make sure that we're balancing everything to align with the goals, but also align with your risk tolerance. So hopefully that's helpful. Thanks, Sam. Next question came in from Rachel. Rachel asks, how do I know if my investments are performing well? So Rachel, there is a number of ways you can do this, but depending on what you're invested in, sometimes it's super simple and sometimes they make it a little more complicated. So if we use the example of your superannuation, because that's probably going to be the easiest one, depending on what you have invested. But if we take your superannuation account, that is invested in something. I'm not sure what it would be invested in, but it's invested in something. So all investments within reason have a obligation to report the performance on a semi-regular basis. So some of them do it yearly, some of them do it every 6 months, some of them do it quarterly, and some of it gets reported daily. So it just depends on what you have invested. But the way I would do that is, again, using this superannuation example, is log into your superannuation account and you should be able to see a performance tab. So if you just do a quick search of whatever you're invested in, so XYZ company or XYZ superannuation fund, choose the investment option you're invested in and just search for performance. And in the performance, it's going to give you a range of time frames. So it's usually depending on how long the investment fund has been around for, but they'll usually give you a time frame of like 10 years, 5 years, 3 years, 1 year, 6 months, 3 months, 1 month. So they'll give you that time frame. And what you're looking for, it's usually expressed as a percentage return. So it'll usually say over the last 12 months, it was a percentage return. So what that means is if you invested $1,000 and it gave you a 10% return, then that's what your investment should be worth over that year time frame. Now there's fees and taxes and things that come into it as well, but very simplistic way of thinking about it is you just take the percentage return and that should be expressed over a time frame. Now the hard thing is we never know what the share market's going to do going forward. We can only ever look backwards. So the thing to not hung up on is always looking at what the past performance was. So it doesn't always give us a true indication of what the performance is going to be going forward, but it does tell us what the performance has over the past period of time or the previous period of time. So it will always, or not always, but it'll sometimes also give us a benchmark. So it'll say this investment fund, it has what's called a mandate and it also has a benchmark. So it might say this particular investment fund A has a benchmark that it is tracking against. So it'll say this is a particular investment that we are benchmarking ourselves against, and this is what the benchmark performance was, but then this is what our performance was. So we can kind of see and compare the two of, okay, well, how did it perform compared against other investments in its similar asset class, but then how did it perform against its benchmark as well? And the key thing to think about there is not in all investments are the same. So it's not always a good idea to compare investments with other people unless you know exactly what they're invested in. And this is one of the issues that I have with the advertising around superannuation funds on TV, where they say XYZ superannuation fund performed by 8% over the past 12 months. But they don't always tell you the investment option that it's invested in. So they just name the superannuation fund or the investment fund. They don't say the investment option that it's invested in. So if you're talking with someone at work about how their superannuation is performing or how their investment is performing, and they say, look, I've got X return on my investments over the past 12 months, and then you look at yours and it's something different, it's always good to ask that follow-up question of, okay, what exactly are you invested in? Because you might be invested in something completely different that your investment returns might be appropriate for how it's invested versus someone else that it might be appropriate as well. So it's not always easy to compare against, or you shouldn't always compare against other people's investments. But that'd be my suggestion. Contact your superannuation fund, log into the website, and you should be able to see it. If you've invested outside of superannuation, you should be able to do a quick Google search, log into your corresponding investment platform or share portfolio of wherever you're invested in, and you should be able to see how that investment has performed over time. The next question came in from David. David asked, I want to invest for the long term. What are some good strategies? So depending on what your definition of long term is, because this can change for everyone, but typically a long-term investment strategy has a combination of growth assets and defensive or income assets as well. And again, understanding what your definition of long-term is, what your long-term plans are, but we find making regular contributions into a low-cost investment option over the long term, consistently, do it every single month, and basically don't change that for a long period of time. Set up a regular investment every single month, same day, each month, same amount, and unless something drastically changes, you just continue to do that for a 20, 30, 40-year period, and you'll wake up in 40 years' time and be very, very wealthy. So the superannuation is a prime example of this, where notwithstanding the fact that you can't touch your superannuation, it is an investment account that your money goes into it every single month or quarter, depending on when your employer puts money into it. And assuming that it's been invested appropriately, it gets invested on a regular basis over a very, very long period of time, over your working life of 30, 40, 50 years. And then you have that large sum of money at the end. So again, look at a compound interest calculator and we can see what that does. But long-term, choosing the right mix of investments, choosing appropriate risk for your risk tolerance and your time frame, making regular contributions over a long period of time is a good strategy. Hopefully that's helpful. All right, next question comes in from Sarah. Sarah asks, I'm not sure I understand all the jargon and technical terms. Can you explain them in simpler terms? Yes, Sarah, completely understand where you're coming from. And I am sometimes guilty of this as well, where my level of financial knowledge, I sometimes assume that everyone knows it as well, but I always have to catch myself and realize that not everyone knows all this technical stuff. And yes, there is way too much jargon when it comes to finances and personal finance. So again, I would suggest that you educate yourself as much as possible. So if you are starting on the journey of investing and you hear a word, just Google it, make a note of it. So I would create a Word document. It's called My Investment Dictionary or My Investment Terms or whatever you want to call it. And every time you hear something that you don't know or don't understand, Google it, try and educate yourself on it, and make a list, make a note of it so that you know it for the next time. Again, there's a number of free resources on this that literally have a dictionary of investment terms. But if you're doing your own research, that's one thing. If you're working with someone like a professional accountant, financial planner, stockbroker or something, and when they're explaining something to you and you don't understand it, it's always important that you ask the question. There's no such thing as a silly question. That's one of my rules with my clients, is there's no such thing as a silly question. If you don't understand something, ask. It's always important to ask so you fully understand what you're doing, what you're getting involved in. It's sometimes you might feel silly or stupid to ask a question because they might look at you a bit funny when you ask the question. But if that's the case, if you're not feeling comfortable with whatever you're doing, then it's probably a good idea not to do it until you fully understand it. So I would suggest you just do as much research as possible. If you hear a term that you're not sure on, just write it down, Google it, YouTube it, and try your best to learn as much as possible. All right, the next question came in from Mike. Mike asked, how do I know if I'm making the right investment decisions? So Mike, it's completely natural to have some doubts and concerns about investing. And the reason I say that is because there's so much information out there. And what you're wanting to do or what you have done in terms of your investments is going to be completely different to what your friends, your family, work colleagues, whoever has done. And it can be really easy to play the comparison game of like, oh shit, what have I done? Have I done something wrong? What are you doing with your investments? And everyone plays this comparison game, but it's always important to understand and be super clear. And that's what we want to start with. What are the goals? What are the timeframes? What is your risk tolerance? And what you're doing, your investment should be for you. There shouldn't be for anyone else. So even though it might be cool or fun or to see what other people are doing and like maybe jump on different trends or something that's like new and exciting. But if you know why you're investing, if you know what your investment goals are, how long you want to invest for, what your tolerance to risk tolerance is, then you shouldn't have any doubts about what you're doing if you are super clear on those things. So the right investment decision is going to be different for everyone. And the right investment decision is the right investment decision for you. So it's getting you closer to your goals, it's getting closer to, it's invested in your time frame, and it's invested for your risk tolerance. So that would be my suggestion, is that there's no one right investment. So it's going to be different for everyone. But again, it comes down to education. Educate yourself on different investments. Look at the performance of how it's performing. Understand what the long-term trends are or long-term investment performance has been for those particular asset classes, depending on what you're invested in. And just make sure that it is aligning with your goals, your timeframes, and your risk tolerance. So that would be my suggestion for you, Mike. All right, so next question comes in from Katie. Katie asks, I'm interested in investing in real estate. What should I consider? So Katie, this is a super interesting question. And this is something we're actually going to cover in next week's episode. So last week we covered the investment basics, and next week we're going to be covering all things investment properties and real estate. So we're going to do a deep dive into different types of real estate and investment properties. So I can give you a brief answer now, but be sure to check in for next week as well. And we'll go into this in a lot more detail. So the short answer is that I don't have any particular affiliation with, I only invest in shares and not property, or property and not shares. We help clients invest in all different assets, which is suitable to their goals, their timeframes, and their risk tolerance. But real estate is a lot simpler to understand than stocks and shares, which is something I covered in last week's episode, which is why we tend to see a preference for most people to want to invest in property, because they've either had some experience in owning a property before or rented a property, so they kind of understand how that works. What also makes it a little bit simpler and easy to understand is that you can usually touch it, so you can go and see it. It's a physical thing, whereas investing in stocks and shares on the share market, it's just numbers on a screen basically. So it can be a little bit daunting to go down investing in stocks and shares versus property, where you can see it, you can touch it, and it's a real physical thing that you can see. So that usually makes it a bit easier, but it's not without its risks and challenges when it comes to property investment or real estate. There is obviously a number of risks that come with it as well. So it's, again, important to do your own research, understand, educate yourself as much as possible before making any investment, and especially real estate, because it's usually a large commitment up front. So we talked about before, micro investing with stocks and shares, where you might start off investing with $100, whereas when it comes to property or real estate, the minimum amount you have to put up is going to be in the tens of thousands of dollars rather than the hundreds of dollars. So it does come with some initial challenges as well. But be sure to check in next week's episode and we'll answer your questions in a lot more detail. All right, so the final question for today's episode comes in from Lisa. Lisa asked, I'm worried about the tax implications of investing. What should I know? Lisa, thanks for the question. Tax is unfortunately one of those tricky ones where it's a necessary evil in some regards, where no one necessarily wants to or likes paying tax. But once you understand, and obviously depending on which country you live in, once you understand why you pay tax and the benefits that you get from paying tax to an economy like Australia, is somewhat tolerable, if that's the way to put it. But when it comes to investing and tax, there's a couple of things that you do need to know, and there's two sides of it. So there's the income tax that you pay, and then there's a capital gains tax. So income tax, much like the income that you earn from, if you have a job, you get paid from your job, you pay tax on that money. So if you earn money through investments, if we take the example of real estate, it gets a little bit complicated, but if we take the example where you get rental income, that rental income is income and you have to pay tax on it. Now, when it comes to real estate investing, which we'll cover a lot more in next week, but when it comes to real estate investing, you have the rental income. So if you're getting paid $1,000 a week from your rental property, then you have all the deductions and expenses that you can deduct from that income, much like you would in your personal income. When you lodge your tax return, you would say, this is the income I earned from my employee, but I had all these deductions that were work related. So this is my car, my phone, my home office, my work clothes, all that kind of stuff that you used, all those expenses you incurred to earn that income are deductible. So those are tax deductions. So the same thing happens with real estate. If you have an investment property, $1,000 income comes in, but then you have all those expenses that are related to you earning that income. So some of it might be the interest on your home loan, the property management fees, any repairs and maintenance you had for the property, any bills, expenses, and things like that come with that property. Those are deductions. So we have the gross income that you earn, which would be the $1,000 a week, less all the deductions, and then you'd have your net income. So that net income, which is income minus the deductible expenses, that net income gets added to your tax return at the end of the year. So let's say you get to the end of the year and you've earned $20,000 from your real estate investment. You have $100,000 in salary, you take that net income from the rental property and add that to your salary, and that would be your taxable income in $120,000. So that's the income side of it. It is quite complicated. And the issue that I find, or the thing that I find that people aren't aware of, is when they have what's called a positively geared investment property or a positive cash flow investment properties. And that is they're making money. So the income they're earning is more than the expenses related to that property. So therefore they're making money. So then they have to pay tax on it. And what happens when you don't have appropriate money set aside? So you might have gone 3, 4, 5 years of working and never had an investment property, never made money from an investment property, then your employer is always paying the appropriate amount of tax for you. So you might not have to pay any additional tax at the end of the year, or you might get a tax refund. Then you add an investment property, and if you're not careful, that if you're earning money and you're earning extra taxable income, which is a good thing, it's always important that you set aside an appropriate amount of money in case you have to pay additional tax. So it gets to that point where your employer's putting the money away for you from your earned income, your income from your work, but they don't know that you have an investment property on the side. They don't know you have these other investments. So they're not putting tax away for that. They're only putting tax away for the money they need to, which is your salary income. It's your responsibility to put away or set aside the appropriate amount of tax for any other additional taxable income that you might have to pay tax on. So that's the income tax side of it. And the same is applicable for stocks or shares investment portfolio that you might have. So what we just spoke about then was the real estate side of it. But when it comes to an investment portfolio, like we covered last week, where we have the rental income for a property, we have the dividend income from an investment portfolio. So any dividends that you earn from an investment, gross income, same thing as when it comes to real estate, the amount of money that comes in, less any relatable expenses that it incurred in earning that income. So this might be investment platform fees or financial advisor fees, all those kinds of things. Then you have your net income. That net income gets added to your taxable income at the end of the year. So that's the income tax side of things. The other one is the capital gains tax. Now, without going into too much detail, because it is quite complicated, but when it comes to capital gains tax, this is the tax you potentially have to pay if you sell an investment. So if you had an investment property, I always like to think about investment properties because they're the easiest one to understand. If we bought an investment property for $500,000 and we sold 5-10 years later for $1 million, we've made a $500,000 profit. Now that $500,000 profit, assuming it's investment property, if you never lived in it, etc., there's a couple of other things to think about, but it's been an investment property for the entire 10 years that you've held it. That $500,000, subject to what's called capital gains tax discounts, that $500,000, you have to pay tax on some of it. Now, again, depending on how long you've had the property for, what your taxable income is, what stage of life you are, etc., would depend on how much tax you pay on that profit. But it's just important to know that there is income tax, which is the tax on the net income from any investments that you earn. And then there's the potential capital gains tax, which is any profits you've made after selling this investment, whether that's a share portfolio or a property. So as it can get quite confusing, so it's a really good question, but if you have a particular question or something that's slightly more complicated, I always suggest, again, do your own research or talk to your accountant or talk to your financial advisor about what are the potential tax implications of this investment, because there's going to be different investments are going to have different tax implications. So it's really important to understand what that is before you potentially get involved in any investments. But the summary of that is if you are paying tax, it means you have been making money. So again, no one wants to pay tax, no one likes paying tax, but if you're paying extra tax, it means you're making money, which is a good thing. So thanks for the question, Lisa. All right, so that wraps up today's episode. I hope that you found that helpful, answering some of your questions about investing. Always remember, as I mentioned a number of times in this episode, it might start to sound like a broken record, but it's important to do your own research, understand your financial goals, understand your time frame, understand your investment tolerance or your risk levels. And if you need further assistance, always reach out to a professional, whether that's your accountant, financial advisor, stockbroker, whoever that might be. And just remember that investing can be complex, it can be confusing, but it is a very important part in building your wealth and setting yourself up for the future. So I hope you found that helpful, and be sure to check in for next week's episode where we're going to talk about all things real estate and investment property investments. Have a great week.
If you've enjoyed this episode of More Than Money, make sure that you subscribe to keep up to date with all of the latest episodes. And feel free to like, comment, and share with a friend.